Welcome to The Explainer. I am so glad you're here today because we're tackling one of the absolute most fundamental concepts in the entire financial world. But, we're going to do it a little differently. So often when people talk about investing, it just sounds like this chaotic mix of confusing numbers, fluctuating graphs, and those intimidating ticker symbols flashing red and green on a screen. But today, we're completely shifting that perspective. We're going to strip away all that unnecessary complexity and reveal the living, breathing reality behind what it actually means to own a stock. Here's our roadmap for today. First, beyond numbers on a screen. Then, how stock ownership actually works. Next, why companies sell their shares. After that, what shareholders actually receive, followed by how stock prices really move. And finally, thinking like a business owner. Let's get right into it. Section 1. Beyond numbers on a screen, the reality behind the ticker symbols. Imagine, just for a second, that you're walking past a massive, famous company's office building. Maybe it's a globally recognized tech giant, a car manufacturer, or huge retailer you buy from all the time. Millions of people use its products. It employs thousands of workers, and it brings in billions of dollars in revenue. Now imagine someone taps you on the shoulder and says you can actually become one of the owners of that exact company. Seriously. You don't have to start the business, you don't have to interview to become the CEO, and you definitely don't need billions of dollars to buy the whole operation. You just need to purchase a stock. Which brings us to our foundational question. It's simple, but the answer completely changes how you view the financial world. What exactly is a stock? Well, the crucial point is this. A stock is a legal ownership claim on a real business. It represents a partial share of that company. When you buy a stock, you become a shareholder, which means you legally own a small portion of that exact business. And this is where most beginners kind of get it wrong, right? They think stocks are just this abstract video game where numbers go up and down. But no, absolutely not. It is a legal piece of a living, breathing operation. Section 2. How stock ownership actually works. The bakery analogy. To really grasp the mechanics of this, we need to zoom in a bit. We're going to use a super simple microscopic example to make the math of ownership completely intuitive. Let's imagine a local bakery in your town, and the entire business is worth exactly $100,000. The owner decides to divide the business into 1,000 equal slices, or shares. That means each share represents 1,000th of the company. If you buy just one single share, you own 0.1% of the bakery. But if you buy 100 shares, you legally own exactly 10% of that entire bakery. Your ownership percentage simply depends on how many shares you own relative to the total number of shares that exist. It's just pure, straightforward math. Now, let's scale that exact same concept way up. Instead of a $100,000 bakery, imagine a massive public company worth $100 billion. To accommodate that kind of size, the company might have billions of shares outstanding. So when you buy a share, yeah, your slice of the pie might be mathematically tiny, but the fundamental reality hasn't changed one bit. Even if your percentage is microscopic, it is still completely real ownership. And that is exactly why shareholders are formally called owners. Moving on to Section 3, why companies sell their shares, the quest for capital. So, okay, we know what a stock is, but why do these pieces of companies even exist for us to buy in the first place? Think about it from the perspective of the business founders. You've built a highly successful, incredibly lucrative company. You're making real money. Why in the world would you willingly slice up your precious pie and sell pieces of it to strangers like you and me? The short answer? Capital. Businesses need a lot of money to grow. Companies might need to build massive new factories, fund the research to develop the next big product, expand their operations internationally, hire thousands of new employees, or dramatically upgrade their technology. Now, sure, a company could try to borrow all of that money from a bank, but instead of taking on all that heavy debt, a company can raise capital by selling shares to investors. You provide the money, and in return, they give you an ownership stake. It allows the company to fund its biggest ambitions, and it allows you to participate in its future success. Win-win, right? Now, I really want to clear up a massive misconception here. When a company first sells its shares to the public, yes, it gets the cash. But once a company is publicly traded, its shares are just bought and sold on stock exchanges. So most day-to-day trading actually occurs between investors. If you log into a brokerage account today and buy a share of a major tech company, you are not handing your money to the company itself. You're usually just buying that share from another everyday investor who decided they wanted to sell theirs today. The company isn't directly involved in your transaction at all. Section 4. What shareholders actually receive. The benefits of ownership. So what do you actually get for your money? A lot of folks out there think stock ownership just means staring at a screen and hoping the squiggly line goes up. But because you are a legal owner, you actually receive specific tangible rights. There are 3 core benefits to ownership here. Step 1, voting rights. Many common stocks actually give you the right to vote on corporate matters, like electing the board of directors or approving major corporate actions. And sure, large institutional investors have way more influence because they own millions of shares, but your vote is still a legal right. Step 2, dividends. A dividend is a direct cash payment made by a company to its shareholders. It's essentially the company sharing its profits directly with you. And step 3 is capital appreciation. Imagine a smartphone company launches an amazing new product, profits absolutely soar, and everyone suddenly wants a piece of the business. Demand for the stock rises, and the price goes from $50 a share to $100 a share. That increase in market price over time is capital appreciation, and it's the primary way investors build long-term wealth. Now, there's a really common fork in the road for successful businesses, because not all companies pay dividends, and here's exactly why. Fast-growing companies, think of those in the booming tech sector, often choose to take their profits and reinvest them entirely back into research, new products, and expansion. They're trying to grow the company's total overall value. Mature companies, on the other hand, well, they already have stable, predictable cash flows and maybe fewer massive expansion projects on the horizon. So instead of reinvesting everything, they regularly distribute those profits directly into their shareholders' accounts as dividends. Both are totally valid ways to benefit you as an owner. Okay, I do have to burst a bit of a bubble here. If you own part of a company, can you just march right into the corporate headquarters, kick open the CEO's door, and demand they change the color of their logo? Definitely not. There is a very clear separation here. Stock ownership gives you economic ownership. You get the legal rights, the share of profits, and the formal votes. But the day-to-day operational control? That is handled by hired executives and employees. You own the company collectively with millions of others, but management runs the business on your behalf. Section 5. How stock prices really move. Fundamentals over short-term noise. So if management is running the day-to-day business, how does the value of your piece actually change? Look, another huge misconception is that stock prices just move totally randomly. And in the short term, sure, prices bounce around constantly based on news, emotions, and investor psychology. But over the long term, business fundamentals are what act like gravity. True investors focus strictly on business fundamentals. They ask things like, is the company's revenue actually growing? Are they generating real profits and cash flow? How much debt are they carrying? Do they have a really strong competitive position in their market? And do they have high-quality management? Over the long term, successful businesses create value for their shareholders, and struggling businesses destroy it. It's really that simple. Now, here's a totally surprising insight, a real most people don't realize this kind of moment. Let's say a company announces they made record profits this year. You might naturally think, awesome, the stock price will automatically double today. But sometimes, the stock price actually drops. Wait, why? It's because stock prices reflect investor expectations, not just current profits. If investors already expected those massive profits months ago, well, the price probably already went up back then. If the newly announced profits are great, but slightly less than the market was expecting, the stock might actually fall. Understanding that the market is essentially a giant, forward-looking expectation machine is absolutely critical for your financial literacy. Section 6. Thinking like a business owner, a shift in investing mindset. Everything we've covered today points toward one massive shift in how you should approach investing. But before we make that final shift, let's just see where stocks fit into the broader world. If you hold cash, you get great stability and liquidity. You can spend it instantly, but it grows very, very slowly. If you buy bonds, you're essentially loaning your money to a company or government in exchange for fixed interest. It's a great tool for regular income. But stocks are entirely different. Because stocks are actual ownership in productive, growing businesses. They have historically played the absolute biggest role in long-term wealth creation. But of course, business is real life, and real life has risks. As an owner, you have to face some practical realities. Stock prices can fall. Individual companies can and do go bankrupt. When the broader economy hits a recession, consumer spending drops, which hurts business profits across the board. That is exactly why economic indicators like GDP, inflation, and interest rates actually matter to you now. And importantly, it's exactly why diversification is absolutely essential. Because any single business can fail, smart owners spread their money out across many different companies to protect their wealth. So, how do you stop acting like someone just chasing short-term price trends and start acting like a true owner? Well, next time you look at a stock, ignore that squiggly line on the chart and run through this owner's checklist. Ask yourself, what exactly does this company sell? Who are its customers? How does it actually make its money? Is the business growing? Who are its strongest competitors? And crucially, will people still want these products 10 years from now? If you can answer these questions confidently, you aren't just trading symbols anymore. You are fundamentally evaluating a business. Which leaves us with this final, incredibly powerful truth. A stock is not just a number on a screen. It is ownership in a real business. Once you truly internalize this simple concept, the entire intimidating world of investing suddenly makes sense. You aren't gambling on numbers. You are participating in human enterprise and innovation. Everything you will ever learn about markets and wealth building starts right here with this foundation. Thank you so much for joining me for this explainer. The only question left to ask yourself is, what business will you choose to become an owner of tomorrow?